The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The Fed gets ready to pivot and the markets start to rotate. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. T-minus 2 days.
Till what?
Till we get the moment. It's the Fed moment.
Oh, I've been waiting for this.
And all answers will happen and we'll have complete clarity in the markets. No, I'm just kidding. So here's your score set 2 days before we're getting those rate cuts potentially. S&P is just up by 0.1%, but it's the S&P equal weighted that hit a record high today. That was the big news. You have yields lower, you have the dollar lower, and you have gold at a record. We've seen this playbook set up in the past, and it seems like that's the playbook into the Fed, Romaine.
With the equal weight at a record, maybe it's the broadening of this rally that deserves attention here as the market action really is pegged firmly around anticipation of the Fed's crucial pivot this week, a cut in rates for the first time in more than 4 years. But what the start of this rate cutting cycle looks like is anyone's guess. Senator Elizabeth Warren demanding a cut of 75 basis points to protect the economy. Former New York Fed President Bill Dudley making the case for a 50-point reduction. But Manny Roman over at PIMCO says maybe you should just dial it back just a bit.
Well, we're in the camp of 25, but I always say we have a crystal ball, and at the end of the day, we'll see what the market does. It may very well be that it doesn't make that much of a difference, and our view is that there will be 3 cuts of 25, and at the end of the day, what matters is where we are at the end of the year.
Year end, indeed. But for year end, those bets are still aggressive. Swaps markets pricing in almost 120 basis points of cuts through December. And betting rates at the end of 2025 are going to be at least 2.5 percentage points below where they are today. That's a bold bet, and it's exactly why BlackRock strategists have turned underweight short-dated treasuries, saying the extent of Fed cuts that the market is betting on is unlikely to pan out. Now, that differing of opinions is really stoking a lot of the volatility and stoking the stock market rotation. A rotation Savita Subramaniam over at Bank of America says should focus on financials, utilities, and real estate. Watch the flows, ignore the noise. She says it's okay to embrace dividends. It's okay to embrace safety. And Alex, she says it's okay to be boring.
I really think it's okay to be boring. That's what I'd like my weekend to be. This is another way of looking at what Romaine was just describing. It's a great chart from the Bloomberg here that goes all the way back to that top that we hit in July for the index. And this is normalized as of July 16th. Now, since then, and this counts that August slowdown, since then it's really been real estate, which is this purple line, as well as utilities, which is that blue line that's really outperformed, up by 11%. The S&P is down just 1%, but it's the outperformance of S&P in real estate that is pretty profound. Plus, you have the Mag 7 just cannot kind of recoup and down by about 5% over that same time period. It was interesting to see it back and normalized, Romaine, over the last few months, that it really has been that safety and those dividend plays that have done really well.
Yeah, quite interesting to hear, see what the market is doing without the help of some of those big Mag 7 names like Apple, Nvidia, and Amazon here on this Monday afternoon. Melissa Brown, Managing Director of Applied Research over at SimCorp, joining us now to kick you off to the close. And Melissa, let's start a talk about that broadening that we've seen in this market. Not just whether it sticks, but whether the Fed rate cuts or the start of this easing cycle, whatever it looks like, is that the main catalyst for this?
I think that is certainly one of the catalysts for it, because it's hard to find anything else to point to that might be explaining these various moves. I think it's maybe easier to explain why tech seems to be stalling out a little bit. It's become such a big part of the market. And, trees don't grow to the sky, so it's not surprising that it has stalled out. It is maybe a little bit more surprising that some of these dividend-paying sectors have done so much better, though.
Have you embraced that, though? I mean, because we talk about all of the calls that we've seen by strategists and other sort of investment professionals saying, look, now is the time to start looking towards some of these safer plays, or traditionally safer plays, if you will, financials, real estate, utilities. We've seen utilities do very well this year. In fact, I think last time I checked, it's the best performing sector in the S&P 500.
Yep.
Yeah, I've noticed that as well. And I think that as rates come down, and investors are seeking some kind of income, that utilities are certainly a good alternative. I've also seen some analysis of utilities actually benefiting from the AI revolution as they embrace some AI techniques and can run more efficiently. And so, yeah, it isn't that surprising to see utilities doing so well, along with real estate as well.
So what's the path of least resistance, do you think, this week? I mean, is it going to be buy the rumor, sell the news for the broader S&P for Wednesday? You have to kind of stick to your guns and buy on dips of where you think is going to outperform. What's your playbook?
I think my observations have always been it's buy the rumor, sell the news. And if we've got this, kind of interplay between is it 25, is it 50? I think 25 may end up being a little disappointing. Mm-hmm. And 50 may be where the sweet spot is. Although we still think we're going to see a 25 basis point cut. And because, the Fed has been very cautious up till now, I don't see any particular reason that they would change that in the absence of, kind of new data that confirms that they really need to get going on these rate cuts.
Which is really where BlackRock's call came in that Romain was talking about, that they're going to go underweight the front end because there's just too much optimism for big cuts coming in from the Fed. What do you think of that call?
Well, yes, there does seem to be potentially too much optimism for the big rate cuts. But I think you also have a potential flip side if the rate cut is, 50, that maybe investors start to say, oh, wow, maybe the economy is worse than we were thinking. And that's also not good news. So, I agree that, we probably will get 25 and that, maybe we need to be cautious on that 50, but for two different reasons.
Do you think, well, first of all, would you be disappointed? And more importantly, do you think the market's going to be disappointed if you don't get a more aggressive move on Wednesday, i.e. 50 basis points, or in absence of that 50 basis points, at least some rhetoric out of Jay Powell that suggests that the pace of those rate cuts would pick up?
I would not be disappointed if we only got 25 basis points. I actually think the economy has seemed to do reasonably well with this higher level of rates that we've had for some time. So I personally don't see the need for that big a rate cut. I also maybe don't expect Powell to have a lot of rhetoric about what's coming, because he rarely does. I think one big issue coming up is the election. You might have heard that there's an election in the U.S.
Oh,
unfortunately, yes. We have heard this.
And I think some of the policy statements that have been made, may suggest a more inflationary environment, and that could potentially give the Fed pause. Not necessarily on this cut, but and maybe not on the next cut, which comes right after the election, but maybe going forward after that.
All right, Melissa, great discussion as always. Melissa Brown, Managing Director of Applied Research at SimCorp, kicking us off here on this Monday in what is going to be an incredibly busy week. But before we get to the big show on the week, we have to talk about Boeing. More turbulence for the plane maker amid that big labor dispute out in Seattle. Now learning that the company taking some measures to preserve cash, including freezing hiring. A breakdown of the latest cost-cutting measures.
Plus, demand for the latest iPhone may not be as flashy as Apple hopes. We're going to dig deeper into why one analyst is warning investors to temper those expectations. And
a lot going on in the retail sector, and we're going to do some retail sector therapy. Mickey Drexler, the CEO of Alex Mill, formerly the CEO of J.Crew and The Gap, going to be joining us later in the program. All that and more coming up in a bit. This is The Close on Bloomberg.
I'm David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
All right, let's talk about RXO. It's a freight broker, and it's now the third largest in the United States. This is after the company completed its acquisition of Coyote Logistics, which it bought from UPS, closing that deal this morning for just over $1 billion. Pleased to say that the CEO of RXO joins us right now, Drew Wilkerson. Drew, First of all, congratulations on the deal. This is a pretty sizable deal for a company your size. Does this actually add new markets to your business, or does this just expand in the ones that you already had?
Well, the first thing it does is it gives us a lot of scale in the freight brokerage market. And we know that scale matters in broker transportation. What it will allow us to do is it will allow us to leverage lanes where we know Coyote buys transportation better than what we do, and where we buy transportation better than what Coyote did. So for us, that will allow us to pull down purchase transportation and hopefully run at increased margins. But what it does for the different sectors that we're operating in is Coyote was heavily based in food and beverage and in transportation. And RXO was heavily based in industrial manufacturing and retail and e-commerce. So there's not a lot of customer overlap. When you look at our top 25 customers, there's only overlap within 3 of them. So we're really excited about the scale that this adds to the organization. And it allows us to move up to the 3rd largest freight brokerage and have a lot of momentum at our back as we start to hope for an inflecting market.
When you talk about the platform that RXO already had prior to this deal, moving or expanding from industrial into more food and beverage here, does that require significant changes to your platform in order to accommodate that type of business?
It really doesn't. Both of us have great technology, and so now what we do is we become one organization. We're looking to put the technology together and create what's the best of both worlds for our customers, for our carriers, and for our employees. But there's not a lot of updates or changes that are needed within the platform, especially when you look at the RXO platform. This is a platform that we spend $100 million a year on. So there's a lot of investments that have gone into technology, and technology has been at the core, which has allowed us to operate at some of the strongest margins in the industry. So it's something that we're very excited about.
So, Drew, something that was impressive about this is that it kind of happened at the bottom of the cycle. Where do you see the cycle being right now?
We're at the bottom of the cycle, and if you look, we don't think that there is a lot of room for carrier rates to continue to come down. No, I don't know how quickly the cycle will turn. It's something that we're monitoring. Right now, you still have far too many carriers out there for the amount of demand that is there. So you have to see more carriers exit the market, or you're going to have to see demand pick up overall. But what this does is this shows that we're doubling down on our freight brokerage business. We're more prepared now for an inflection than what we were prior to the acquisition, and we were already in a very good spot. This is the right time for us to be able to do a deal of this magnitude.
So let's just game it out for a second. You know, we're anticipating a Fed rate cut on Wednesday and the cycle beginning. What's going to be the magic sauce that's going to really support this market and really turn it around and help those margins that you are now well set to capture?
So we're going to watch closely what happens on Wednesday. And if you see a Fed cut, I think that you could see consumer confidence start to come back. And then what happens there is, where does the consumer spend their money? And does the consumer spend their money on goods, or does it still spend their money on experiences? So for us, if they spend their money on goods, we're in a good position to be able to help customers make sure that the goods can reach the end consumer as fast as possible.
I am curious, Drew. I mean, last week there was a big trucking conference held by Morgan Stanley, big investor conference here. It was interesting hearing some of the commentary, including from your companies and affiliated companies. Is there a sense here that what we're seeing in the industry now is going to be much more idiosyncratic? Because there was a lot of disparity in what I heard from one company versus another, versus another, versus another. Not everybody was singing from the same hymn book.
I don't know that anybody's been singing from the same hymn book for the last 2.5 years. I think it's been a down market for 2.5 years, and it's been tough to call the inflection point. So what you've heard us say is that we're at the bottom of the cycle and we're prepared for the inflection. We know that more capacity has to come out or demand has to pick up for us to see that inflection, but it's all about making the right steps and having a playbook no matter what the market is. And this acquisition at this time is a huge part of our playbook.
Are you looking at other strategic M&A, Drew?
We're always looking at strategic M&A. Right now, we're laser focused on making sure that we execute the M&A that we got complete today with Coyote Logistics. But if there's something out there that complements one of our other lines of business, like managed transportation, or allows us to grow in other modes of transportation, like LTL or intermodal, this asset light, then we would absolutely entertain it.
When you take a look at the ideal scenario for you guys in terms of truckload versus less than truckload mix, what is it? And what does that tell you about that macro environment?
We built the business on full truckload. And so if you look at what we do today, 83% of our business is full truckload. 17% of our business is less than truckload. Now, that's a segment that's actually been growing for us significantly. We've been growing at 30 and 40% on a year-over-year basis. When you look at why we're growing it with our largest customers who do truckload business with us, that love the platform that they're operating off of. They love the service that they're getting, and they've got great relationships with their reps that are working with them on a daily basis. So they've come to us and said, can you take a smaller piece of our business and smaller piece of our transportation spend, which is less than truckload, and can you help us in a complete outsourced way? So we've seen a lot of traction in that area. Now, Coyote has been the opposite in how they've grown LTL. They've grown it with the small to mid-sized customers. So for us, we've got even more momentum heading into growing our LTL book of business.
All right, Drew, we only have about 30 seconds left, but I'm remiss in not asking you a question that is really on the mind of my brother-in-law. I want you to look at your calendar. October 12th, your South Carolina Gamecocks versus his, and I say his, not mine, Alabama Crimson Tide. Who you got?
I will be there to watch South Carolina with Alabama that day.
All right, I will tell him that.
All right, Drew, always appreciate that. You and sports, cool. Drew Wilkerson, RXO CEO, congrats there on the deal. Always got to end on sports, man.
I know, Alex, it's a sports world. One day.
It's true, though. It's true. One day I'll participate.
All right, well, when we come back, we are not going to talk sports. We're actually going to talk about mortgage rates because, of course, there is a big Fed rate cut coming, and a lot of people are saying this could be a huge positive for the real estate sector, specifically for the platform Zillow. That's according to Wedbush. We're going to hear from the person behind that call in our Top Call segment. That's coming up next here on The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start off today with GE Vernova. Barclays launching coverage of the electric power company with an overweight rating. Barclays electrified by the growth outlook for clean power generation and grid. You like that, Alex?
I did. I like that a lot.
And grid technologies. Thanks to EVs and AI data centers. It also sees substantial buybacks and rapid dividend increases ahead. The price target set to $250, implying about a 9% upside from that $228 you see on the screen. Next in line, Sprouts Farmers Market, an upgrade to outperform over at Evercore ISI. The analysts saying the grocery chain well positioned to benefit from a healthy eating wave that will see consumers dining at home more and going for organic or gluten-free options, which are the majority of Sprouts' products. The price target also shooting up to a street high 120 from 196. The shares up 4.5% to 106 and change. And finally, let's take a look at Zillow, an upgrade today to outperform. This by analysts over at Wedbush, which also lifted the price target to a street high $80 a share from 50. Lower mortgage rates being the key factor for that upgrade. The analyst also sees positive revenue growth trends from Zillow's software and services initiatives. Those shares up about 5% here on the day, and those are some of our top calls. We do want to stick on that last one with regards to Zillow. Jay McCanless joining us right now. He's Senior Vice President of Equity Research covering home builders and real estate over at Wedbush. All right, Jay, let's start with the interest rate side of this because this is obviously the most anticipated rate cutting cycle that we've had in quite some time. How quickly does a rate cut feed into a drop in mortgage rates and, more importantly, more activity in the housing market?
Thanks for having me on, Romaine. I think we're already starting to see it. We talk in the note about how mortgage rates have moved down nearly 140 basis points from the highs we saw earlier this year. I don't know how fast it's going to accelerate afterwards, but I think, we talk not only about the lower rates, but also we monitor the spread between the 10-year Treasury and the 30-year mortgage rate. That spread has been narrowing as well. So it's good news for affordability, good news for the builders, and I think good news for Zillow as well. And that's why we wanted to get in front of this, ahead of what we think is probably a more benign interest rate environment, and presumably mortgage rates continue to drift lower as we look ahead to the spring season.
For the low, though, that it hit in the beginning of June, I mean, it's up by 60%. Why isn't it in the price?
I think if you look at a couple things that we talked in the note, we left our 24 numbers alone because we still need to figure out what the impacts are going to be from the NAR settlement and some of the changes that are happening to buyer broker commissions. But I think if you look ahead to next year, The forecasters we monitor are calling for anywhere from 8 to 10% existing home sales growth. And then on top of that, we feel like services and software could add another 700 basis points of revenue growth on top of that. And theoretically, too, you could see some M&A in this industry that gives Zillow a chance maybe at some more market share. So we felt like with how bullish some of the forecasts are for next year, in the core business, that wasn't being reflected. And then, we would love to see more disclosure from Zillow on software and services. But I think given the strength and some of the run up we've already seen in their ability to grow revenues faster than the underlying market, it seems like the revenue from the software and services side is starting to tick up. So felt like some of this was certainly in the stock already, but not all of it yet.
So Jay, just forgive my ignorance here, but can you explain a little bit about the software side of this business? I mean, where are these sales occurring? Where is that revenue coming from exactly?
Sure. They bought, I think, according to Zillow, they bought nearly $10 billion worth of different software and services platforms. Some of them are pretty mundane, like Showing Time is a scheduling tool for open houses and visits with realtors. Also, Showing Time helps organize some of the back office functions and some of the reporting that these local realtor boards do. Follow Up Boss, which is the larger acquisition they made at the end of 23, that is a full CRM suite that helps integrate some of these other tools that they have out there. So our questions now, we're seeing them grow revenues faster than the existing home market. So we feel like these software packages are contributing to that. Again, we'd love to see a little more detail as to around how much that's helping, but you can't ignore the numbers. You can't ignore the growth that they're putting up. And so some of these software packages, again, are mundane. Some are a little more involved, but I think collectively they're giving Zillow another source of revenue outside of just an existing home sale.
All right, Jay, thanks a lot. Really appreciate it. Jay McCanless over at Wedbush joining us on Zillow. Here's my question, Romaine. If we get a less aggressive cycle in the market's pricing in, does that disrupt what we're expecting from the housing market?
I don't know. I've been trying to figure this out, and it seems the consensus, at least based on Bloomberg reporting that our print reporters, is that there's sort of this magic number kind of right below the 6% level on mortgage rates that a lot of them feel like that will be the catalyst to get more people, more buyers into the market, is also more sellers listing their homes in the market. Because, of course, that's been the big issue here, is there's just no inventory out there.
But then that happens, that's going to jack up prices again. So, like you're offset with mortgage rates coming with a 5 handle, but then all of a sudden the property you're looking at is more expensive.
That's not rebalancing.
Oh, so sorry. Okay, coming up, we're talking about Boeing. That stock is down a little bit today. It is still big trouble here. We're going to have details on what the plane maker is doing to cut costs as labor disputes carry on. Taking a look at this market here with the S&P pretty much flat on the day, the Dow up by 0.5%. The NASDAQ off its lows, down by about 0.6%, but volume fairly light for a Monday, 2 days away from the Fed. This is The Close on Bloomberg.
Yeah, we have a very strong strike fund, and our members will be eligible for that. There's a lot of opportunity for our members. We've spent the last 5 years talking about saving for this, putting into your individual strike fund, preparing so that we could stand on principle.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele, and that was John Holden, the lead negotiator of talks between union workers and Boeing. You guys talked to him on Friday.
Yeah, we did. And I mean, he was somewhat optimistic about his own potential fortune for his workers here, but he also kind of made it clear he thinks this could be maybe a potentially drawn out process. And I think that's part of the reason why you're seeing Boeing shares down once again here on this Monday afternoon.
Also, this is when they're going to have the most power, right? These union workers have the most power right now. So how they're going to manage that. Of course, a negative for Boeing. The stock's down 0.5%. The CFO announcing cost-cutting measures to tide the company over while it deals with union worker strike. Now, Boeing is implementing things like a hiring freeze, possible furloughs, and halting non-essential travel. And get this, Romaine, senior execs can't fly first or business class anymore.
They can't?
They cannot.
Oh my gosh.
It's getting real. All right, joining us now is Sid Philip, Bloomberg News deputy team leader for global aviation. But I don't, because this is like a crackdown. They're taking some serious steps. Can you talk to me more about how long this lasts?
So this lasts as long as Boeing can actually start delivering airplanes and essentially start generating cash, because Boeing doesn't make any money until they start generating cash. And cash is basically how Boeing gets out of its debt pile. It's got over $45 billion in net debt. And they've had a really hard run since the start of the year. They've been restricted from ramping up production. They've had the sort of quality escapes that's led to management change at the company. And so this is a massive sort of a blow to Boeing in terms of just its recovery and the process of recovering from where it's at. And they will sort of be desperate to try and get the workforce back and running so that they can actually start delivering planes and making cash.
Are we reading too much into this announcement today? Because I think when it crossed the wire and everybody looked at all these measures they were taking, your first reaction is, oh, they're in this for the long. They think this is going to be a long process, or are we reading too much into it?
I think it's all determined by how long it takes to actually get to a deal. I mean, they're going to start talking with the union and mediators tomorrow. And essentially, depending on how that goes, we can see how long the strike lasts. And that will determine what the cash impact will be for Boeing. Mm-hmm. Because essentially, if it's a long, drawn-out strike, it could be a much bigger impact to their balance sheet and their cash book. But if it's shorter and it's more sort of curtailed, it could be less damage.
What is the state of the strike talks right now?
So at the moment, there aren't any talks, but they start tomorrow.
Okay, they start tomorrow. And is the balance of power still with the unions?
It is, because, I mean, the workers have asked for a 40% pay hike as well as a reinstatement of pension benefits. And Boeing, at their last offer, came up with 25% over 4 years. And that the workers, by an overwhelming majority, said wasn't good enough. And so at the moment, Boeing really needs to sort of double down and make sure they can sort of get the workers on site and get them an offer that they can actually get by.
Just a real quick question here, Sid. Does this strike primarily just affect the commercial side of the business?
It does. It's across the board, and essentially, so it's essentially all the workforce that belongs to IAM 751.
Gotcha.
And that's in the Seattle region, California. Essentially, it doesn't affect the 787 because that's made in a separate plant.
Yeah.
But the 737, which is their biggest, like their workhorse, essentially.
Gotcha.
That and 777, 767.
Yeah. All right, Bloomberg's Sid Philip there talking about the latest here on that Boeing strike, and you heard him mentioning the cash situation, because these strikes could actually be the tipping point for Boeing's mountain of problems. Its credit rating potentially taking a hit, with S&P Global Ratings, Fitch, and Moody's all saying that they would consider a downgrade. We're not quite there yet, but, well, what pushes them to that level? Jonathan Root is Senior Vice President of Moody's Investor Service. They were out with the note last week, specifically on this, a focus, Jonathan, on the duration, the potential duration of this strike. When you're modeling this out, like, what's the time frame that you're looking at here where you think things start to get dicey?
We don't have a specific time frame in terms of dicey. We're taking a longer view. What's really important for Boeing is to, the time frame for its commercial airplane business to start generating significant positive free cash flow. The strike will have to get settled, whether it's 2 weeks or 2 months. The company has to start building airplanes, increasing its monthly rate to 38 in order to drive cash generation. So that's our focus. And the importance is the company has $12 billion of debt maturing between now and through the end of 26. Mm-hmm. The challenge is that $3.5 billion is due in May of 25, and $6+ billion is due in February of 26. So the pace, the timing for the strike to get resolved is just going to be the starting point for Boeing rebuilding the production of the 737, particularly Anchor as well, and moving from there. So that's our focus. We're not speculating whether it's a week or 3 weeks.
Well, that's what I'm curious about, Jonathan. When we talk about this idea of sort of cash being interrupted, if you will, they're not necessarily losing orders. This is almost like sort of a dream deferred, if you will. Can they not use that as, I guess, some sort of concession when dealing with creditors and, for that matter, the ratings companies, to say, look, we might be missing out on this cash in 2024, maybe even 2025, but we're going to get it eventually?
Yeah, so coming in, our expectation was that the company was going to start producing cash in 24. Right? No one expected the door plug incident. The door plug incident delayed cash generation, the start of it, a strong foundation, by at least a year. We roll forward to now, we have the strike, and the delay is going to be even further. So this foundation, one strong year, and strong being positive free cash flow in the low single digits, as a foundation for driving the next year's cash flow. And right now, that is just delayed. With respect to creditors, we're not too focused on the creditor relationship at this stage. We're focused on, debt holders. But the actions that were published today, you would expect from any company in this situation to start conserving cash because the duration of the strike is unknown.
Do we have an idea of how much cash the company is burning each week? Can you estimate it?
Don't have a good estimate at this time. The 2008 strike was 50 million a day. Or, remember, the company's revenue declined by $6 billion in that period because of a lack of deliveries of airplanes. The company was building 34 airplanes a month at that time. Mm-hmm. We believe the company was building 30 or so in July and August of this year, but it's not a real apples to apples comparison because of all of the events that have been buffeting Boeing today relative to 2008. So we've seen reports of 100 million a day, but it's a question mark at this stage, but it's definitely material, and the cost per month are going to be greater than in 2008.
So what's going to be your signal on when to cut? Like, if it's not the duration of the strike, what would be the signal then to cut your rating?
So our expectation is that the company needs to raise capital even before the strike because the free cash flow generation was going to be less than the cumulative debt maturities of $12 billion through 2026. Let's also not forget the company is going to purchase Spirit AeroSystems. It has a need for $4.5 billion of equity to close that transaction as well. So we're going to monitor the strike, but importantly, we need to see how long that runs and what Boeing's plans are to raise capital. And at this stage, where the rating is, it's $57 billion of debt. Our expectation is the company is going to have to go raise equity. And we're going to watch to see how the equity markets support whatever the company may do.
I see. Okay, that makes sense. Just play it out for us, though, Jonathan. Downgrading a company of this size, if all three of you guys, Fitch, S&P, and Moody's does it, like, what is the impact of a fallen angel this big in the market?
Yeah, so we're focused on the impacts. The question we get all the time is what's the impact on Boeing? And our view, because of Boeing's importance as a contractor to the DoD and the very limited number of prime contractors, we believe that its defense business will be okay, even if the rating is lowered out of investment grade. With respect to the commercial side of the business, there's a $450 million backlog. The customers need the airplanes. They like the airplanes. It's important that there have been relatively few cancellations over the past 5 years for the aircraft that Boeing builds. So there's going to be support from the customers. Obviously, the cost of debt to the company will increase, but the business will be operating. When the strike is resolved, the company is going to be rebuilding its production. It does rely on there are external stakeholders that are going to impact, the pace. And it's the FAA and the FAA's, monitoring of performance, the supply chain as well, and that the supply chain can support the higher production.
All right, Jonathan, thanks a lot. We really appreciate it. Jonathan Root, Senior Vice President of Moody's Investor Services. Boeing stock down 40% so far this year. All right, coming up, watching investors taking a bite out of Apple shares today after a China-based research firm flagged concerns about iPhone 16 demand. It's today's Stock of the Hour. Coming up next, this is The Close on Bloomberg.
All right, time now for our Stock of the Hour, and it is Apple. The share is down right now about 3% on an intraday basis, having the worst day in more than a month and a half. This after warnings from an analyst about weaker than expected pre-orders for the iPhone 16. Bloomberg's Abigail Doolittle joining us now to talk a little bit more about what we know about what was a very curious note. TF International Securities, which I'm not familiar with, came out with some interesting commentary, basically saying that they're estimating only about something like 37 million units had already been ordered, which would be well below some of the 90 to 100 million units that you saw for previous releases.
Well, my first question when I read all of this was, who is Ming Chi Kuo? Because this is the axe that has sent the world's largest company down as much as 4% at the lows. As you're mentioning, TF International Securities, I haven't heard of them either, but apparently investors taking this very seriously. And that's exactly what he's saying, that in that first 72-hour window, when when these phones were available after the release event, that demand was less than it was on a year-over-year basis, 37 million, down about 13%. And in particular, the iPhone 16 Pro, less demand there, in part because of the Apple Intelligence not being available, and also fierce competition in China. But that, I mean, honestly, I was stunned to see this stock move by, an unknown analyst. Now, that said, he is the biggest analyst I have learned in Asia on Apple. So I think that's why there is that influence.
Well, also, I think that it's the question of, can you have an iPhone super cycle without China? And if you can, and if there isn't that demand, then does that throw all the super cycle thesis into hot water?
Well, I think the super cycle thesis is being thrown into hot water because we just simply don't have that massive demand. Now, there is a possibility that there's more supply than demand, and our own Bloomberg Intelligence Anurag Rana says that it's too early to know. What we do know is that it's a 21.5-day waiting time versus last year, a 32.5-day. But there could, again, it could be a supply issue. However, when we bring the Apple suppliers into the picture, Qorvo, which is about 50%, Skyworks, about 66%, Qualcomm, they're plunging. I mean, these stocks are down 6-7%. So that, to me, I think you can infer it's not a supply issue because they would know.
I saw Cirrus was down. Micron was even down on this. It's like the whole Apple ecosystem.
Apple complex.
Hit. It's like also confirmation bias, right? We're already worried about the super cycle not materializing. Boom, doesn't take a lot. All right, Abigail, thanks a lot. Bloomberg's Abigail Doolittle. We're 15 minutes away from the closing bell on this Monday. We're going to count you down with Anthony Saglimbene, a chief market strategist at Ameriprise Financial.
Welcome back. Tupperware, an iconic U.S. brand we are learning is preparing to file for bankruptcy as soon as this week. This is according to people familiar with the plans that Bloomberg reporters have spoken to, saying that a years-long effort to revive the business amid waning demand has now fallen short, and now they are in protracted negotiations here to file for bankruptcy protection. You see the shares there on your screen, Alex, down 49%, but this was already a penny stock, and kind of remarkable because I don't know if you remember, this was a penny stock prior to March of 2020. And then I guess when we were all cooped at home, baking cookies and other things, apparently everybody rediscovered Tupperware again. The stock was like a $35 stock.
Yep, no more. And this has been sort of a while coming at the end of the day. I mean, earlier in the year, you had a restructured commercial chief role coming into play. You also had the company entering into forbearance with lenders. They also delayed their 10Q quarterly report back in May. So there were all these different signs that clearly things were not going well for this company.
Yeah, and we should just point out that Bloomberg did reach out to the company. They declined to comment. The Bloomberg reporters also saying that the plans aren't final, but could change.
Well, broadly in the market here, we're just about 9 minutes away from the closing bell, looking at S&P up on the day by about 0.1%. But interesting is what's leading it. You have the KBW Bank Index. You have Bank of America coming in and saying that actually some of these names are going to do really well, like a Goldman Sachs and Wells Fargo. A soft landing is better than a declining net interest income. So it's okay if that fundamental demand is there. You get energy also on the upside as well. It's just tech, a little bit of a lagger.
Well, maybe that's one reason why we're seeing that S&P equal weight that you were talking about at the start of the show, trading at a record high here, a broadening of the rally that I think some people might actually welcome. But of course, a lot of questions about what comes next. A big easing cycle scheduled to start this week, and a whole lot more that could push this market in any direction. Anthony Saglimbene joining us right now, chief market strategist at Ameriprise Financial, counting us down to the closing bell. So just about 8 minutes to go. And Anthony, let's actually start off with the relative broadening that we've seen in this market. I know there's been a lot of ups and downs and a lot of questions about just how much further this rally can go. But the last few up days we've had, the last few up weeks we've had, we've seen greater participation. I would think that that should bode well for the markets overall.
Yeah, I think you're right. A lot of the broadening rally has to do with this concept of a soft landing. And so we've seen over recent weeks employment slowing, inflation moderating lower, giving more leeway for the Federal Reserve to cut interest rates. And so we'll see on Wednesday whether it's 25 or 50 basis points. But it's really about this concept of easing monetary conditions to allow some of the other areas that haven't kept pace with big tech this year, that ability to start seeing profit growth and in a growing economy, participate in this rally. And I think investors have been getting ahead of that. Yeah. There is a little bit more defensive tone in the market. So you guys have been mentioning staples and utilities. So I do think there's a little hesitancy from investors to jump all the way in. But I do like seeing this broadening part of the rally.
We'll talk a little bit more about that defensive side, because you can look at some of the gains that we've made and say, okay, people are making bets on economic conditions, maybe even making bets on improving corporate fundamentals for those left behind. But as you just said, there's also a lot of people that are just basically scared right now. And for whatever reason, they think they can find solace in those names.
Yeah. So defensive areas like utilities and consumer staples, they offer those defensive properties in a portfolio. And with the uncertainty around whether the Fed can engineer a soft landing, I do think investors are looking at these sectors as either a place to hide out or participate if they do engineer a soft landing and we see the economy remain positive with those lower interest rates. Those defensive sectors or interest rate sensitive sectors tend to perform a little bit better. And so with the Fed, based on market odds, expected to cut 75 or 100 basis points this year, those types of areas, utilities, consumer staples, even financial, should perform a little bit better in that type of an environment where we are avoiding a recession.
So, Anthony, we're actually pricing in now 119 basis points of cuts so far this year. If we get a dot plot that says 75, as you just mentioned, what's going to be is there going to be downside for the market?
Yeah, I think whether it's 25 or 50 basis points, that's not really the main focal point, or shouldn't be the main focal point for investors. It's really, what does that policy statement look like? Does the Fed give a little bit more credence to slowing growth, maintaining employment? I think that's what investors want to see in the policy statement. And then we're going to get the summary of economic projections and update on Wednesday, and we're going to get their forecasts on growth and inflation. But most importantly, we're going to get to see where committee members line up in terms of where the Fed funds rate will be at the end of this year and the end of next year. Our expectations is that you're going to see more policymakers start to lower the front end of that rate. And so we should see in that dot plot a lower median rate for 2024 and 2025. If we get that, I think investors will react positively to that. It could be sell the news, but if we see language in the policy statement that gives a little bit more nod to slowing growth and a dot plot that sees rates come down a little bit more on the front end, I think investors in the market will be happy with that.
So we're talking about defensives. When do cyclicals come into play?
I think, areas like financials and industrials and materials, these areas that can benefit from continued growth, I think it might be a little bit early for these sectors, because I think there is a little bit of caution of whether the Fed can really engineer that soft landing. I look at profit estimates. They seem high for 2025. Markets, based on analyst estimates, they see S&P 500 earnings growing by another 15% in 2025, and that's over the 10 to 12% we're going to get this year. And so if the Fed has to lower interest rates more aggressively, it's likely because growth is slowing. And in that environment, I wouldn't expect industrials and materials to do very well. So I think it's a little bit early for those sectors. That's why you're seeing utilities and staples do well. But I do believe that if we get to the end of the year and the Fed is able to cut 50 and 75 basis points and growth is remaining positive, employment trends are still positive, I do think that'll give investors confidence to start looking at these areas. And certainly financials is one of those areas that seem to be where investors are maybe going early ahead of that cycle.
In aggregate, meaning looking at the market in aggregate and earnings expectations, particularly for 2025, we're getting into that time of the year where we're going to start to see a lot of analyst estimates, a lot of strategist estimates. Are these going to be upgrades? Meaning, are people going to start raising their forecast for what they expect next year?
I think it depends on the environment. So, I think we're going to have to see a few more reports on inflation and employment. And then, as you mentioned, the Q3 earnings season's coming up here in October. So we're going to get a whole batch of company updates. And I think we know what to expect on the big tech side. Really where I think investors are going to have questions is around the demand environment for some of these other cyclicals. And we've already seen on Q2 earnings calls that demand for services and some of those leisure areas that have done really well have started to moderate. Obviously, consumers are more discerning about where they're spending right now. And so I think before you see analysts raise estimates, they need to be comfortable with the estimates they already have. So S&P 500 earnings are expected to grow by about 7-8% in the third quarter, and then in the fourth quarter by well over 10%. So I think before analysts are willing to raise estimates, they need to be confident that their Q3 and Q4 estimates are on the right track.
All right, Tony, got to leave it there. Anthony Saglimbene, Chief Market Strategist over at Ameriprise Financial, counting us down to those closing bells, just a little bit more than a minute away. Well, the NASDAQ is down, the S&P is up, and the Russell is up. Is that sort of credence to this idea of a broadening?
Yep, and you have two-year yields down, you have the dollar down as well, and gold at a record. So that feels very much like safety on the one hand, and then broadening/safety on the other hand.
Interesting to see that some of the volatility indices are moving a little bit higher, the VIX slightly higher, the MOVE index higher as well here. So, and when you look at the swaps market, you definitely see some folks preparing themselves for a lot more volatility, not just because of the Fed, but of course with the U.S. election less than 2 months now?
I don't know. There was a countdown clock.
50 days. That's
50 days. Oh, my goodness. But I do think that the question is, are we so one-sided now going into Wednesday that if we don't get 50 or if we get not 119 basis points of cuts priced in for the dot plot for this year, is there just going to be a sell the fact kind of situation?
I mean, you can't come with any surprises, right? I mean, at this point, particularly after Jackson Hole, when Powell basically made it clear, now is the time to start cutting. They better start cutting, right?
Yeah. Well, yeah. But if it's 50, if it's not 50, all of a sudden we see a sell-off and you got to sort of sell the front end.
All right, we get the closing bells here in New York on a Monday afternoon. First Citizens ringing the bell there over at the NASDAQ. Insurers lemonade over at the NYSE here. 6 straight days of gains for the S&P 500, with the 6th day being a somewhat modest posting. Up less than 10 points on the S&P 500, but that's still good for about 0.1% point gain. The Dow Jones Industrial Average up about 0.6%, while the NASDAQ is going to close lower by 0.5%. Your relative outperformer on the day, at least relative to the S&P, that actually belongs to the Russell 2000, up about 0.3%, Alex.
Hey, I'll take it. I'm taking a look at the IMAP here. It is definitely a mixed pie. You have information technology, the worst sector within the S&P. That's definitely down by 1%. On the upside, though, financials over 1%. Some positive commentary coming out of Bank of America on that. Also, energy doing really well. Remember, that sector got real beat up there. We had oil falling. We're like the most net short in oil like ever, at least in the past 13 years. And now we're getting a little bit of a rebound, but it's also materials, communication services doing well. So still those cyclicals as well as value outperforming the market, hence the SPW equal weighted index hitting a record high today.
We should point out about 380 members of the S&P 500 closing in the green on the day. Bailey Lipschultz joining us right now to talk about the biggest movers, not just gainers, but also decliners. Where do you want to start? Are you a half glass full or half glass empty kind of person?
Can we start with the best performer in the S&P 500, Intel, which just right now crossing the wire announcing they're in a multi-year framework deal with Amazon for products and wafers. So not only did the stock have its best day in quite some time, though it's still down 58%, it's rallying in the post-market after news of an Amazon partnership. So a bit of positive news right now, up more than 6%. Anytime you throw around Amazon, you throw around a chip deal, it feels like people want to buy the stock.
And we should just point out here, this breaking news here from Ian King, Alex, here. They're going to co-invest in this, Intel and AWS, and that's a big deal here because there's been a lot of talk, of course, about Intel's financial commitment to this. But obviously with AWS set aside, as Bailey said, obviously maybe that gives investors more comfort.
That's interesting. We will get more of this later with Ian King, but Intel and Amazon in multi-year framework for products and wafers. All right, number one.
Positive news. Number two, outperforming on the day was Merck, having a pretty strong day, just given kind of choppiness across the health space. This is coming after data from their blockbuster Keytruda drug showing that it helped women with a hard-to-treat form of breast cancer live longer. This drug brought in more than $7 billion in the last quarter. It's one of the best-selling cancer medicines of all time, so really further cementing Merck's position in the breast cancer space.
Wow. Yeah, what else you got,
Well, we can pivot now to some of the underperformers, or maybe taking a look at Apple coming after that news of TF International Securities warning that pre-orders in the iPhone 16 Pro lower than expected, 37 million estimated units, down 13% compared to the iPhone 15 launch. Wow. The sticking point to me, though, was the fact that apparently the sales pitch for the iPhone 16 is Apple Intelligence, and that's not actually going to be implemented when you buy the phone.
And that's why people aren't buying this thing?
But you'll get it. It's just an update.
I thought that they were saying it's going to come later this year.
I know, but why would you? I guess why would you pre-order something if you can wait and see what other people?
Because it has a teal color.
Who would pre-order an iPhone?
Romaine.
I don't know anyone who would do that.
But to your point, it's not just Apple. Their suppliers, like Qorvo, is the worst performing stock on the S&P.
Well, that's what I was going to say is the worst performers in the S&P. You have Qorvo, you have Skyworks. Skyworks, Micron, all of these suppliers making chips that kind of power those phones. Worst performers in the S&P 500, really another negative data point if you're trying to tease out what the future for the handheld devices kind of environment looks like. That's why you saw those stocks really littering the bottom of the S&P 500.
What iPhone are you on?
15 Pro.
Oh, there you go.
Yeah, I got the purple
So you're
space
hip.
dust.
Oh, wow.
It was the first time I've ever.
Space
Yeah,
dust?
I think
No,
so.
I have no idea what that
Wait,
is.
was that
but
the
it sounds
lavender
fancy.
color?
No, it's a dark purple.
I have lavender.
Oh, you have lavender?
I would like the dark purple,
It's
though.
deep purple.
It's deep. It's Stardust.
Stardust.
I mean, let's go with
If
that.
not,
I mean, all right, Bailey, we appreciate that. Thank you very much, Bailey Lipschultz, joining us on all the movers. Been interesting to see sort of how our setup is into Wednesday.
Yeah, absolutely. And as we talk about that setup into Wednesday, let's bring Gina Martin Adams into the conversation here, our chief strategist here over at Bloomberg Intelligence. And Gina, we've been talking a lot about how this gigantic Fed easing cycle is really going to reshape things. But I know you and your team have been taking a closer look at cash and the cash that companies have, and more importantly, how they're using that cash.
Right.
If I'm an investor, is that cash going to rain on me?
Yeah, it seems like it is. So if you
Yeah.
haven't noticed it yet, you should soon.
Yeah.
We've got buyback growth that's up 37% year over year, dividends in positive territory, CapEx in positive territory. They're spending everything that they can, clearly, because free cash flow growth is falling now year over year. So they have definitely deployed their capital very rapidly across the board. The only sticky point is M&A. They seem to be a little bit stingy on M&A, but still deploying when it comes to cash as a share of those M&A transactions. That also increased in the second quarter. So we are seeing cash deployment right back in action for S&P 500 companies after that little bit of cash hoarding that they experienced in 2020 to 2022.
Are we seeing buybacks too with that, in comparison to other times?
Yeah, so buyback growth is 37%, so it's leading the charge among capital deployment trends, though I will say some of that is because of an easy comp. This time last year, buybacks were contracting by 25-30%, so companies were really scaling back. They've re-engaged in buybacks. They're reinitiating buyback programs. To the degree that they have had cash flow growth over the last year, they are deploying it via buyback.
This may be a dumb question, but there's been so much hand-wringing about market valuations, particularly with some of the big tech names and those high flyers here. But a lot of people, their argument for why those valuations were justified was because, A, these companies were still growing on revenue, they were still posting decent margins, and more importantly, they were generating cash like all get out.
Yep, and that's true. Now we're starting to see a little bit of a shift in that. So their cash generation growth, at least on a year-over-year basis, their EBITDA growth does appear to have peaked over the course of the first half. So those Mag 7 companies and even the tech sector at large posted peak earnings growth rates in the first half. We're starting to see those growth rates wane. It doesn't mean that they're not going to continue to grow relatively rapidly. Indeed, they'll likely grow faster than the rest of the index right through to the middle of 2025. But we are finally seeing some other stocks on the index post earnings growth. And I think that will ultimately result in free cash flow growth, some momentum emerging for non-tech names, which will probably help us right-size those valuation distortions that are in the index. If you look at the median stock in the index, it's trading at levels that are pretty much normal. If you look at the pre-COVID 5-year average, that's right where the median stock is trading. If you look at the S&P 500 equal weighted index, likewise, it's trading at a multiple that is equivalent to its pre-COVID 5-year average. So there's some movement beneath the headline of the S&P 500 that's really creating a little bit of volatility, a little bit of crisis for the index at large.
That's what I was going to say, because
overall,
if
there are winners and losers.
If you wind up rotating, does that support the headline index, or it can't really continue without tech? But on a sector level, it'll be okay.
Yeah, the way that I characterize it is the index will struggle as long as the Mag 7 is struggling. So you can have, we've had financials breaking to new highs, utilities breaking out, staples breaking out, industrials breaking out, healthcare breaking out. You can just name the list of sectors that broke out to new highs in August. And yet the index at large really failed to continue to break higher because the Mag 7 is struggling. It's just too big. When semiconductors, which is the biggest industry in the S&P 500, is failing to make new highs, it's very difficult for the index to move higher when you have this degree of concentration risk. It just means that active strategies should perform quite a bit better. It does mean that, it doesn't mean that there aren't opportunities. It's just at the index level, your returns are minimized by this rotation trade.
All right, Gina, thanks a lot. Really appreciate it. Gina Martin Adams joining us of Bloomberg Intelligence, Chief U.S. Market Strategist. Romain?
I think we want to go back to that Intel news. We talked about the idea of this multi-year framework that Intel has now brokered with Amazon Web Services. We're also learning that the company plans to establish its Intel Foundry business, often referred to as IFS. It will be further separated from the rest of the company and eventually become a wholly owned subsidiary. So essentially creating some separation between that and the rest of the company. We should also point out that as part of this new partnership with Amazon and the focus here on a foundry here in the U.S., they're going to pause plans for factory projects in Poland and Germany for about 2 years. They're going to complete that factory in Malaysia, but not necessarily start operations on it. So a lot here to digest. We're going to get the reporter in just a bit here to give us a fuller breakdown of what's going on here. But this could be a big deal for Intel. At least investors think so. Stick with us. This is The Close on Bloomberg.
Welcome back to The Close. I'm Alex Steele.
And I'm Romain Bostic. Another wild day on Wall Street. The S&P 500 up for a sixth straight day. And as everyone is focused on that 56.67 level for the S&P's record high, maybe you should focus on the equal weight S&P 500. The SPW hitting a record high here on this day as that rally starts to broaden out. The Russell 2000 outperforming the broader market for yet another day here, though you do see that move in yields here on what could be a busy week for rates traders with the big Fed meeting ending on Wednesday.
All right, let's look at some of the biggest movers. To the downside, we have Apple, and I just pointed out Qorvo as well, one of its suppliers. Apple shares falling after TF International analysts said the demand for the iPhone 16 Pro series is lower than expected, and this is based on pre-order analysis of that first weekend, and suppliers really took that seriously. Qorvo, the worst performing stock in the S&P. Want to get to Intel as well, up 6%, and also post-market also moving higher as well. A couple things happening with Intel. The latest news is that it looks like its Intel Foundry unit will be they're moving it to be independent. Plus, they're selling, there's some real estate. They are committed to the U.S. manufacturing, sort of thinking about how to manage the Malaysia construction. They're also manufacturing products with Amazon wafers and other products as well. That really helping Intel after hours up over 10%.
Yeah, we want to stick on that story because it is the big story here in after hours trade. Ian King, the Bloomberg reporter who helped to break that story, joining us right now, fresh off an exclusive print interview with the CEO, Pat Gelsinger. And Ian, I do want to start off with this idea of separating that foundry business into what you say in the story is a wholly owned subsidiary that could maybe even have more distance between it and Intel. Explain that to me.
Yeah, I mean, if you are a prospective customer of this, if you're going to give it your crown jewels, your manufacturing, you might be a competitor. So you want to see some kind of separation here. And this is Intel acknowledging that reality, that if you want NVIDIA, if you want AMD as a customer, you've got to show them that there's a gap between that and your product division and that they can trust you. And this is what's going on here.
Is that really what was holding some customers back, or was it actually what they're making?
Well, what Pat Gelsinger said when I spoke to him was like, look, we had to have world-class manufacturing again. We didn't. We've absolutely spent a fortune rushing through these various stages to get ourselves to that level. Now we're in a position where we can say to our customers, hey, come and use us. We're just as good, if not better, than everybody else.
So when we talk about the idea that some of the other projects, including those plants in Germany, Poland, and even the one in Malaysia are, I guess, let's just say being put on ice, for lack of a better term here, Ian. Should we read more into that? Is this the idea of just refocusing on the U.S., basically doing one thing and doing one thing well rather than trying to spread itself thin?
This is financial reality imposing itself. Pat has produced this spending plan, this massive expansion plan that's just no longer supported by the current business levels. He's acknowledging that. He's saying, look, me and the board, and he just told me that now, we went and had a really close look at what we're doing, and we've realigned ourselves with this new reality. In the future, we can open these back up and we can expand into them, and that would be the plan. But for now, we're going to preserve cash to spend on what we really need to spend and what we really need to do.
So the agreement that they're working with Amazon for products and wafers, is that a big deal? What does that mean for Intel?
I mean, this is the headline. This is what Intel has needed all along. It needs companies like Amazon, one of the biggest spenders on data center chips, to come out and say, okay, yeah, you're good enough, we'll use you. We don't know the exact details. The fabric chip is kind of a networking chip, so that's probably not the mainstream kind of chip that Intel would hope to be making millions and millions of for a company like Amazon. But guess what? It's a start, and it's a good start. And for Intel, if you're an Intel kind of skeptic, you wanted to be seeing these kind of big names associated with that foundry effort, and now they've got one of them, so that obviously helps. We'll see how it pans out, but it really helps.
Give us a sense here about the partnership with Amazon. Obviously, this is, I think, what a lot of investors are sort of latching on to here. Would this have happened if they didn't have a partner of that size and scope?
I mean, this is a very complicated situation. In the past, Amazon used to buy exclusively pretty much from Intel. Over time, it decided to make its own stuff, to design its own chips, which were a partial replacement of what Intel sells it. Had TSMC build those chips. Now it's saying, hey, some of those things that kind of replace your stuff, we're going to have you make for us. So that's a partial return of business to Intel. And that's really what Intel is trying to do, to say, hey, if you're not going to buy our stuff, maybe we can make your stuff. And that keeps us in the game. And that's, again, underlines, what that effort is about. And Amazon is giving them at least a glimmer of hope in that effort.
All right, Ian, thanks a lot. We really appreciate it. Great to get that print exclusive from you at Pat Gelsinger. Ian King joining us from Bloomberg. But man, I mean, Intel has a long way to make up. I mean, just take a look at that stock price just in the last year. The last 6 months have been no joke. Yeah, well, I was looking at the rate of change on the Bloomberg terminal. If they actually get to that 10 plus percentage point gain we've seen here in the after hour session, that occurs in the cash session, that's going to be one of their best days in a couple of years, at least since late 2022. So investors have been starved for some sort of good news out of this company. Yeah, anything to go. And also, I was interested to see that the Germany and Poland plant will be delayed by about 2 years. Malaysia seems a little bit TBD, but they're still committed to the U.S. manufacturing. No doubt that has to be a subsidy story as well. Absolutely here. All right, we'll keep an eye on that. In the meantime, we are keeping an eye on the Fed and the big rate cut expectations mixed across the board. We're going to get those forecasts up ahead next on The Close on Bloomberg.
Wednesday, the Fed decides.
I know we're all obsessed about what the Fed may or may not do on September 18th.
25.50, that doesn't matter so much.
We're being very measured where maybe other central banks aren't.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
We have made no decisions about future meetings, and that includes the September meeting.
At this point, the Fed is leaving it open.
It's going to be up to Chairman Powell.
Tune in to Bloomberg Surveillance, The Fed Decides, starting at 1:30 p.m. Eastern.
Investor is pricing in 119 basis points of cuts by the end of this year, which means we could see at least 1/2 point cut. Charlie McGilligan of Nomura said there is a one-sided easing bias into weaker labor market data. So where does that leave the S&P then for Wednesday? Citi sees a 1.2% move to the up or downside for stocks, meaning that it's going to be a bumpy day. Bloomberg's Jess Menton joins us now. Jess, talk us through some positioning into Wednesday.
So you were just talking about that 1.2% swing in either direction for the S&P that day. So for context, that would be the highest implied move for the index since March of 2023. So that's back when we had the height of the regional bank crisis. So just to put into perspective what the elevated moves there are for that. But if you look more specifically with the positioning and kind of underneath the hood when it comes to sector positioning heading into this, Deutsche Bank actually put together some data. So probably not surprisingly, it's sectors that, yes, they are defensive, but also they're more of the bond proxy-like sectors that tend to benefit from when there are rate cuts. So if you're thinking about utilities, real estate, staples, even healthcare, industrials, those tend to benefit. And that's where you're seeing people piling more in. So, and then they're cutting those positioning that they had in, say, mega cap tech or growth stocks. But those, to be put in context, I mean, in July, those were near record highs there for that positioning.
Well, we're showing them on the screen here. And it's interesting because at least those big four that you see there, obviously they benefit if rates do come down. These are also, anyone who studied this, late economic cycle type of trades. And this seems to be the conundrum right now in the market. Everyone's cheering these rate cuts that are coming. But you kind of forget that sometimes rate cuts come because the economy might not be doing well.
Well, it's a good point, but then also Alex and I have talked a lot about the utilities sector this year because there's different components in industry.
Does she like just corner you in the hallway and be
yeah,
like,
that's exactly
utilities, natural gas?
Well, part of that, you would have looked at like the rate of change and the big pop they saw, say, going back to April, and a lot of that was tied to the data centers and the AI type of story. So I think in theory, if you look back through history, you'd think, okay, well, is that an alarm sign or a warning bell? But actually, you've seen other particular corners of utilities tied to like the growth story taking off as well. So it's a little bit more tricky, but I mean, still, the economy looks very strong when you're looking at a lot of the data and the consumer spending data. So it's hard when you have a once-in-a-century pandemic and you go back to the different cutting cycles to try to compare. Because if you go back to 1989 and the 6 prior cycles to now, the S&P 500, as long as it averted a recession, so excluding the dot-com bubble or the great financial crisis, you still saw double-digit gains 6 months later and 12 months later.
And on the other hand, we have like outside positions in different asset classes, right? Like the 2-year has just gotten, the yield has just fallen, dropping like a stone, right? We have a net short for the first time since at least 2011 when it comes to oil. Like these are outside positions that I feel like then are we set up for something dramatic in other asset classes on Wednesday as well?
Well, look to what volatility is trying to tell us as well as skew. So that's basically showing us what does hedging look like in portfolios. And you can look 12 months out or you can look at the shorter term indicators. So if you look at where the VIX closed today, yes, of course, it is below 20. It was around 17, but it's still 15% higher than its average this year. So that still shows you it's still trading above, obviously, its 200-day moving average. So once it crosses back below that, that would be more of a bullish indicator for equities.
All right, Jess Metton helps lead our equities coverage here. A closer look here at some of the plays people are making ahead of a big rate cut decision coming up this Wednesday. We do want to stay on this topic, particularly about the impact of the Fed easing cycle. Bloomberg's Nina Trentman joining us right now. She had a chance to speak with bankers, strategists, and CFOs about how they are navigating what we think is going to be the Fed's path forward. And I always say think because we're always just assuming that all these rate cuts are coming and God knows what the heck Jay Powell's going to do on Wednesday. But you had a chance to catch up with some of these folks. What are they saying?
Well, we are seeing, of course, companies are positioning themselves, thinking about what do lower interest rates mean for my business? What do they mean for the fixed rate debt that I have? What do they mean for my cash? So it's a plethora of decisions that companies will have to make once they know how much the Fed is cutting and also how much it says it will cut going forward. One interesting point was in terms of data that we received for our new or the upcoming edition of CFO Briefing was this, that companies are already making plans and changes to their treasury portfolios. So they basically, even though we know the Fed is likely cutting on Wednesday, we know that they've already started making changes. So Clearwater Analytics, which is a company that tracks treasury investments of about 400 companies totaling about $1 trillion, so quite a significant amount of assets. They found that companies have already started moving into longer duration assets, so into corporate bonds, into U.S. government bonds, and sort of have shrunk the amount of money that is allocated towards money market funds and also other short-term instruments. And so, of course, that is interesting to see because it's not just what is the Fed going to do, but also what do companies think makes sense. And so what this data is telling us is very much this, that corporates think it's good for us if we go into longer duration assets to hold on to those higher returns a little longer.
So what does it mean, though, if I'm a CFO? Do I want to issue more debt like before an election, or do I want to wait until we're into the cutting cycle and then issue more debt?
Well, if you look at the markets right now, then I guess people will tell you that they want to issue when the market is good, which is what we've been seeing for the majority of this year, basically. We've seen pretty strong debt markets, even though we have the looming election. What I've heard from bankers for the most recent edition of CFO Briefing was very much this, that people are saying, well, if we get a clear election outcome and we know who's going to be the president soon after the election and markets respond positively, then we could see a continuation of that pull forward issuance, which of course you would think, well, interest rates are high, why wouldn't you wait? But then of course it's not just the coupon rates that people are looking at, but also the spreads, and they want to find buyers for their debt.
I'm curious, I mean, you mentioned them kind of going longer duration here. We've been obsessing a lot over this sort of record amount of money that we've seen in money market funds. We all primarily talk about it from the investor perspective, individual investor, institutional investor. Corporations, though, have also been piling into that, and they've stayed in that. Is that money coming out already?
Well, some of it is. If you look at the Clearwater data, then, for example, at the end of March, 30% of corporate treasury portfolios were allocated to money market funds. Now that stands at 28%. And of course, that is sort of like only a 2% decline. But if we're thinking about how much money that is, of course, a sizable amount that is coming out. I think over time, corporates will probably allocate a certain amount to money market funds just because it's a pretty safe investment. You also have a lag effect where you can hold on to the returns that you get on a money market fund a little longer, even if interest rates come down. But I think it's going to remain part of the portfolio,
All right, Nina Trentman, a closer look here at what corporations are potentially doing with their cash ahead of the big Fed meeting. Of course, Nina leads our CFO briefing newsletter, which is devoted to corporate finance. When we come back after the break, we're going to do some retail sector therapy with none other than Mickey Drexler. He's the chairman over at Alex Mill, formerly of J. Crew, formerly of The Gap, right here on Bloomberg. All right, let's take a look at one of the best performing subsectors in the U.S. market so far this year. We're talking about a retail rebound. Apparel makers like Abercrombie & Fitch and Urban Outfitters finding new lifeblood among younger consumers. And well, I'm happy to have a man of great retail expertise joining us right now. Mickey Drexler joining us here in Studio 2. He's currently the chairman of Alex Mill. He's also, of course, the former CEO of J. Crew. And of course, everything you know about Gap's heyday, he is responsible for. Great to have you here, Mickey.
Nice to be here. Thanks for inviting me.
Let's talk about the state of the kind of this fashion. I don't know if we call it a revival, but we've seen a lot of kind of brands that really were kind of up back in the day and fell, and now have found themselves back on top once again. And I wonder if that is just the cyclical nature of fashion or if this really is about management and leadership.
Well, I'm probably a bit of a contrarian to that because I think it's the nature of fashion, but being on top, I'm not sure how you define it, having a good year, having a good quarter, and I think it's about the long-term building a great company. I don't hear business around this so good from my little surveys I do. I think I know those two companies because they reported good quarters. I don't really follow much, but I read the papers, of course. I've making calls around all types of retailers, friends of mine. It seems like it's not so good.
Why not? What are you saying?
Well, and then there's a big tell. But this is just verbally what I hear, word of mouth. I went online last night to see what I consider a big tell about business. There were more sale goods than I've really seen much before in the middle of back to school, or whatever they call it, in September. There were companies, tons of markdowns. So, you know, the bottom lines or the sales might look good.
Right.
But I don't know if businesses are being built.
But I'm surprised by that because when we kind of came, during the pandemic, there was this sort of sweet spot where you didn't really see a lot of sales because they didn't have to. Inventory was under control, people were buying. And there was all this talk among analysts and strategists saying that retailers would never return to, not never, but at least in the short term, wouldn't have a reason to go back to that heavy promotional cycle. But you're seeing that now?
I think it's gotten worse.
Yeah.
Again, it's not like heavy research, but I go online all the time, and I always tell people before you spend a nickel on anything, go online. And I think one of the trends is, again, my own experience and observation, I see a lot of deals online that aren't necessarily in the stores. To me, it's not being fair customers. But no, it's just, again, my sense.
Yeah.
And I looked at a lot of the big players and the little ones, but markdowns and deals all over the place.
But how do you navigate that? When you were running J. Crew and Gap, online sales weren't really a thing, or at least certainly not the way they are today.
Right.
You now have a new company, at least you're chairman of it, over at Alex Mill. So you have to be much more cognizant about getting people into the brick and mortar stores you have here in New York, but also, of course, the online and direct-to-consumer experience.
Of course. You deal with it. Customer integrity means you pay the same price online that you pay in the shops. And I learned at my first job at Bloomingdale's think about it. You see a price here. Oh, I'm sorry I'm not online today. It's not fair, and it's not integrity. And, the discount businesses, because I have friends who run some of the big discount companies, they're taking advantage of lower income, not lower income. But I think, again, their businesses are strong. And but you have to be very straight, honest, always as a retailer. But I think it's a bit of a race to the bottom, in my opinion.
I do want to ask you, though, about the actual fashion trends and what people are wearing, or at least what they want to wear. Obviously, you have sort of created, or to a certain extent, or fostered a certain kind of timeless, kind of classic style.
You just said the right words.
Well, okay.
Timeless, classic, and no expiration date.
And no expiration. And
this jacket
people
is
want
20
that?
years old. Well, people... Yes, in my opinion, I'm a little surprised. And I always say products number one, number two, number three, the goods. And for me, again, it's just what I practice my craft doing, is clothes that are long-term. Well, what you're wearing, what I'm wearing.
Yeah, I look great.
You look great.
But thank you for that compliment. But how hard is it to do that? I was looking at, for example, let's take the Ruffle Oxford, which Alex Mill put out, and a lot of people have copied since then.
Right.
You look at it, it's a nice shirt, but it's pretty big. But how do you come up with that idea and say to yourself, I think this will stand the test of time?
Well, I think it's more style than trend. And these shirts, I wouldn't wear the same shirt. For me, I call it almost amortizing your wardrobe. But you wear something, I love the designer clothes, they're my friends, but I like normal clothes.
Yeah, so you're not wearing like those chunky Balenciaga, like sneakers or anything? That's too far gone for you?
For me personally, of course.
Yeah.
But for people in general, I find them just difficult to wear forever after a week or two or whatever. I like clothes that are styled. They are always in style. And even look at vintage clothes. Vintage clothes is one of the hottest categories today. And even all the young kids are wearing vintage
I know.
clothes.
I just took my teenager to a thrift store last weekend.
There you go.
And he was just buying the same stuff that I had as a kid. I guess I should have just saved it and saved us some money.
Right. Well, exactly. And vintage is cool. And the prices, by the way, they say 2.5% inflation.
Yeah.
They probably excluded all apparel. They excluded concerts, not that I go.
Yeah.
And they excluded hotels, among other things. I don't know where the 2.5% comes. The price of apparel, especially at the high end, is stunning.
How do you keep prices? Let's just Alex Mill. How do you keep prices at a relatively affordable level? And more importantly, how do you do that without also having to discount the way your competitors are?
Well, for us and for me, it's a religion to keep prices affordable at reasonable value and not jack up the prices so you can put them on sale to tell the customer, well, the $75 item that's now $49.99 is really worth $49.99. Other than great discounters, I always mention my friends at TJ Maxx, they're the biggest department store and they carry every brand there is. But the jacking up and the lowering, it goes on everywhere, I guess in the car business, get this off, that off. What we do, and I've always done it, we're doing it more religiously now, because we were guilty in all those companies of markdowns. And at Alex Mill, we have two sales a year, and everything else stays at the price. Because someone comes in, it's like a race to the bottom. It's a drug.
Yeah. I've noticed, too, that some of your disciples, people who kind of came up under you, Todd Snyder's, Chris Echevarria, Jenny Ming, a few other people like that, they seem to also have taken the same approach on not just timeless style, but the idea of holding firm on price, at least as long as you can.
Well, it's like I say, for me, it's a religion. And I think I've learned my lessons also. And you mentioned 4 people I love, and there's a whole bunch of people that I've worked with. But, right now with Alex Mill, I've been there over 3 years from a tiny little company. We finally hit our stride. It takes time to build. And our business is uniquely very strong now, and I love the goods.
Does it matter, though, that people aren't necessarily dressing up as much as they used to in the past?
No, I don't. We're not. We're not in the dress-up business. But to me,
but there's a lot of slobs walking around. I mean, even in the office. Let's just be honest.
No, let's be totally honest.
Okay, yeah.
I agree with you.
It bothers me a little bit.
No, well, that's good.
Yeah, all right.
We dress, a lot of slob. See, I couldn't say that, but I don't disagree. Most people don't really know how to. I don't want to sound elitist because I'm not Bronx born, but people either care or they don't care. And I have these things. Either you know about dressing or you don't, or you get stylists. It's not easy. But I wear a uniform my whole life in grade school, except they wore chinos, buckled back chinos instead of jeans. I never thought that's easier. But if you get up every day, see the guys when they wore suits, I thought it was easier to look good because it's more of a uniform.
It is. Some people say people who wear suits are copping out because they're not that, but I don't agree. I wish I had more time. Mickey, this is a great conversation. Always great to see you. We have to get you back on. Of course, a legend in the retail space and the pride of Bronx science. Mickey Drexler, chairman of Alex Mill, formerly over at the J. Crew and the Gap. And we do have a big week of economic data ahead that includes retail sales, among other things, industrial production, as well as housing data. We're going to break all that down in just a minute, of course, ahead of a big Fed decision. Anna Wong joining us in just a bit. This is The Close on Bloomberg. All right, welcome back. Let's take a look back at this day in history. On this day, 32 years ago, in an iconic moment of national shame, the United Kingdom effectively abandoned its European currency peg. A decision made in the face of worsening inflation, increasing budget deficits, and a relentless attack by currency traders. Among those traders was George Soros, who was convinced the government wouldn't raise interest rates enough to keep the pound within that pre-euro system of linked rates. He was right. While the government dragged its feet, investors feasted, sending the pound lower and lower and lower. The Chancellor of the Exchequer, Norman Lamont, he did fight back in the weeks and months ahead of Black Wednesday, even raising interest rates 200 basis points on September 16th alone, while the Bank of England spent billions trying to prop up the pound. It didn't matter. Traders had already hit warp speed, dumping the currency faster than the government could buy. So at 7:30 p.m., as the skies went dark on that Black Wednesday, Chancellor Lamont walked out of the Treasury building in London, and things got even darker. He told his country the UK was withdrawing from the European exchange rate mechanism, that against the advice of numerous economists and investors, the country had just joined 2 years prior. It was a political humiliation. But for currency traders, it was a financial boon. George Soros has referred to September 16th as White Wednesday, given the $1 billion profit he made shorting the pound. That was a trade that turned him into an international superstar, Fleet Street dubbing him the man who broke the Bank of England. And Britain wasn't the only loser. Italy temporarily left the European regime. Currencies in Spain, Italy, and Portugal also were devalued, and even decades of UK monetary policy were killed off when 5 years later, newly named Chancellor Gordon Brown stunned investors by ceding his department's historic authority for setting interest rates to a 9-member monetary policy committee. Neil Kimberley, a senior trader over at Bank of Nova Scotia at the time, later told Bloomberg it was chaos, joking but not joking, that some FX and rates fund managers hit their full-year annual return target between 5 o'clock and 5:30 on that September 16th, 1992. All right, we do want to pivot from that to a week of economic data here in the United States. We have retail sales we have industrial production, and we have the National Association of Home Builders Housing Index due tomorrow. And that's all ahead of Wednesday's main event, the Federal Reserve, the FOMC decision. Anna Wong joining us right now from Bloomberg Economics to talk about the big slate of economic catalysts we have this week. And Anna, let's start off with retail sales and the health of the consumer.
Yeah, so we expect the headline retail sales to show a negative 0.1 monthly growth. So it will be a contraction, and that would be due to pretty tepid car sales in the month, which is not a good sign because typically in a slowing economic environment, the first sign of slowdown in consumption is in durable goods such as cars. And we also have seen in the CPI report earlier that used car prices and new car prices have been slashed by retailers, and so the fact that even that is not stirring more purchases of cars is a little concerning. And then also we are expecting that adjusted on real basis, so inflation adjusted, the negative number would be even more negative. So that's retail.
There's a lot of talk here about the idea of how the Fed rates are going to affect some of the economic data. We get home building data, or at least the housing index, out of the National Association of Home Builders here. I know we haven't gotten a Fed cut yet, Anna, but should we start to expect maybe a little bit more health in the housing sector?
You know, the housing sector typically responds to monetary policy pretty quickly within the first 10 months of a rate hike or rate cut. However, we have seen home building activity slow down pretty quickly, particularly because there's a glut of homes that are coming onto the market in the South. And I think that is causing, that is still yet to play out. And that could be one factor that could cause home building activity to be slow to respond to Fed's rate cuts still.
All right, one last question here. Anna, of course, a big Fed meeting on Tuesday and Wednesday, 25, 50, 75 basis points. What are you modeling?
We are expecting that the odds would favor slightly 50 basis point because the odds have already moved that way and the Fed hasn't pushed back against it. So that's basically a tepid acceptance of the market pricing.
Anna Wong over at Bloomberg Economics down in our Washington bureau. And while most traders are betting on at least 25 basis points, maybe even 50 basis points, as Anna just laid out there, some Democrats say the Fed should aim for 75. Senators Elizabeth Warren, Sheldon Whitehouse, and John Hickenlooper wrote a letter to Fed Chair Jay Powell saying, quote, the committee must consider implementing rate cuts more aggressively upfront to mitigate potential risks to the labor market. Let's stay in our Washington bureau with Kailey Leinz. She is the co-host of Balance of Power. And Kailey, I mean, 75 basis points. I mean, look, I know Elizabeth Warren has always been kind of aggressive when it comes to the help that she wants for this economy. But what's the basis for that type of call?
It's concern about the labor market, Romaine, and you're absolutely right. If you are surprised that Senator Warren is putting pressure on the Fed to cut interest rates, you haven't been paying attention for the last 8 months, because every meeting since January, she has helped author a letter like this, pushing for the Fed to cut rates. Initially, back at the start of the year, her concern was over the effect it was having on the housing market specifically. Now it has morphed into concern about the toll it could take on the labor market, as we're already starting to see some softening in that data. So that's the premise for the larger Fed cut that she thinks should materialize. But of course, most economists aren't necessarily in line with that thinking. What I would note, Romaine, is that considering this is the only Fed decision we will get prior to the election in November, it does have added political significance. And there are even Republicans now, like Senators Josh Hawley or John Kennedy, who's on the banking committee, now pushing for the Fed to cut rates because they, too, are concerned about the economy, regardless of the political impact a rate cut could have.
Absolutely. A political football in an election year. And speaking of the election, Kailey, I do have to ask you about the events of this past weekend, what we know now about that gunman who managed to get close to former President Donald Trump. Obviously, nothing took place, but the fact that he even got that close has to be of concern, not only for him, but for the Secret Service, who are in charge of protecting him.
Yeah, and Romaine, we actually did hear from the acting Secret Service director, as well as the others leading this investigation just moments ago in a news conference. They confirmed that this would-be shooter never even had a direct line of sight to Donald Trump because, of course, he was seen and was engaged with Secret Service personnel and fled the scene before he ever had the chance to actually pull the trigger. And investigators do believe at this time that he was working alone. There has been no sign that he was working with anyone else. That said, there will be further inquiry into not just what happened, but how for the second time in about 2 months, someone was able with a weapon to get within a few hundred yards of former President Trump. Now, the Secret Service acting director did say that they did their job. They were able to thwart this threat, as was not the case when Donald Trump was actually shot in Butler, Pennsylvania, back in July, but certainly Congress will be keeping an eye on this. There already has been a task force formed to look into the Butler incident. They now are expecting to receive Secret Service briefings this week. And even House Speaker Mike Johnson, as well as other lawmakers, have talked about potentially increasing funding and resources for the Secret Service.
What do we know about the protection for the other candidates, primarily J.D. Vance, the vice presidential candidate, and, of course, Kamala Harris and Tim Walz?
Well, they all have Secret Service details, Romaine. The question is really going to be the allocation of those resources, because they are not entitled to the same degree of protection as the current president, Joe Biden, is. Now, that could change. That's something that Rick Scott, for example, the senator from Florida, is looking to change with legislation, increasing the protection for Donald Trump and potentially others as well. And certainly, given the elevated security risk that already was present after the July 13th incident in Butler, we already had seen a ramping up of the protection, but there potentially could be even more pressure to do so. The other thing to pay attention to, of course, in addition to the physical protection, is the rhetoric, as Donald Trump today is blaming the rhetoric from Joe Biden and Kamala Harris for the attempts on his life.
All right, Kelly, we've got to let you go here. You got a big show to prepare for. Kailey Leinz, you can catch her at the top of the hour alongside Joe Matthew on Balance of Power for all your political coverage. Meanwhile, here on The Close, we keep a focus on the markets, a sixth straight day of gains for the S&P 500, but more importantly, the S&P Equal Weight Index hitting a record high as we start to see a little bit of a broadening in the rally. You see that reflected in the bump that you have in the KBW Regional Bank Index, a 1% gain here on the day. In fact, financials and most of the interest rate sectors leading the charge here on this Monday afternoon. Meanwhile, Apple taking a big leg down 3% on the day, dragging most of its suppliers with it. Concerns here that expectations for pre-orders on the iPhone 16 not necessarily living up to par. EchoStar Corp up about 9% on the day on the back of that news that DirecTV and Dish might combine. Stick with us. We'll be back in a moment. Here are some of the potential market moving events over the next 24 hours. We start out at 8:30 a.m. here in the U.S. Retail sales are scheduled to hit the wire on a month-over-month basis. Look for a decline, although we should point out that the Retail Sales Control Group expected to stay about the same at 0.3%. At 9:15, we do get industrial production numbers, which are expected to rebound slightly from the previous month. That could be a boon for the markets, particularly when you get that data that comes out at 10 a.m., which is the National Association of Home Builders Housing Market Index. And of course, the big event of the week, the two-day Fed meeting begins down in Washington. All eyes right now on Jay Powell and that potential easing cycle. That does it for us here on The Close. I'll be back tomorrow, but stick around. Balance of Power is up next, right here on Bloomberg.